negative 34 cents a share, a net loss widening to $263.2 million for the quarter. And yet, Archer Aviation, ticker ACHR, just reported a massive 150% revenue beat for Q2 2026.
Right. And depending on which analyst desk you follow, that EPS either perfectly matched or slightly missed consensus, but they completely blew that top-line revenue estimate of $1.94 million right out of the water, coming in at a cool $5.0 million.
Yeah, and meanwhile, management guided that their Q3 adjusted EBITDA loss is, going to remain flat, hovering somewhere between $170 million and $200 million.
And if you were watching the tape on earnings day, you saw the market react with just pure whiplash to these numbers. And, well, the strategic bombshells dropped alongside them.
Oh, absolutely.
The stock popped roughly 12%, pushing up to around $6.25 a share, fueled entirely by this massive acquisition of Boeing's defense subsidiaries. But as the week progressed and the market actually digested the fine print of the 10Q filings, the stock gave up all those gains, dropping 5 to 7% as severe dilution fears began to really price into the equity.
Right, which sets our mission for you today on the deep dive. If you are a retail investor trying to make sense of this, we are going to look right past that flashy headline revenue beat to uncover the actual reality of Archer's margins.
Yeah, the underlying story is wild.
It really is. We are going to deconstruct this massive strategic pivot to acquire Boeing's defense assets, and we'll map out the dilution trap currently facing existing shareholders. So let's unpack this revenue reality check first.
Let's do it.
I'm looking at a 150% revenue beat, $5 million. But my understanding is that their core air taxi, the Midnight aircraft, isn't actually certified yet. So where exactly is this money coming from?
That is the multi-million-dollar question. Because when you look under the hood of that $5 million figure, the narrative of a cutting-edge electric vertical takeoff and landing company and, an eVTOL company, it starts to look highly deceptive.
How so?
Well, all of it. Literally 100% of that revenue came from their operations at the Hawthorne Airport in Los Angeles. Zero revenue came from their core air taxi business.
Wait, zero. Okay, break that Hawthorne operation down for me. What are they actually selling if they aren't selling flights on their electric aircraft?
Right. So they generated $3 million from what is called an FBO, or a fixed base operator business.
Okay.
An FBO is essentially the infrastructure hub at an airport. They handle traditional aircraft refueling, parking, hangar space, ground support, stuff like that.
Okay.
And then another $1 million came from space leasing at the airport, and the final $1 million came from other assorted facility services.
Okay, it feels like, and tell me if I'm off base here, it feels like Archer bought a gas station just to show Wall Street some top-line revenue while they're still trying to build a spaceship in the garage. I mean, is this just window dressing to distract from the burn rate?
Honestly, that gas station analogy is incredibly accurate, especially when you look at the cost to generate that FBO revenue.
It's high, I'm guessing.
The picture gets grim very quickly. The cost of revenue was $4.3 million against that $5 million top line.
Wait, so they spent $4.3 million just to make $5 million. That means that the gross profit for the entire quarter was virtually non-existent, sitting at, what, roughly $700,000?
Exactly. You are looking at an 86% cost ratio. Running physical aviation infrastructure is expensive. You have master ground lease fees, the cost of the physical fuel, consumables, and something called the amortization of operating rights.
Stop right there. Amortization of operating rights, translate that into plain English for me. Why is that dragging down the profit?
Sure. So when a company buys a facility like an FBO, they often pay a massive premium just for the legal right to operate at that specific highly regulated airport.
Right.
But accounting rules don't let you expense that massive upfront premium all at once. You are forced to spread that cost or amortize it over the length of the lease.
Oh, I see.
Yeah, so every single quarter, a chunk of that initial purchase price acts as this phantom weight, just dragging down your reported profit margin. So anyone buying the stock on the headline that Archer is finally monetizing its technology is severely misreading the financial reality. They bought a traditional capital-intensive infrastructure asset with terrible margins.
And this margin squeeze becomes even more alarming when you look at the rest of the company's expenses. Let's look at the cash burn for a second. Total operating expenses hit $284.2 million this quarter.
Yeah, that's a big number.
It is. Now, research and development is up 52% year over year to $186 million. I expect that. I mean, they are trying to certify a novel electric aircraft with the FAA. Engineering is expensive.
Right.
But what really surprised me was the administrative overhead. general and administrative expenses, G&A, actually outpaced R&D growth. G&A surged 75% to $93.9 million. Why is their front office growing faster than their engineering lab?
Well, that G&A surge is the glaring red flag in this income statement. When the growth rate of your administrative overhead exceeds the growth rate of your core technological development, operating leverage is working in reverse.
Meaning they're getting less efficient.
Exactly. You are becoming a heavier, less efficient company. And of that $93.9 million G&A bill, a staggering $85.6 million was driven by stock-based compensation, alongside a $6 million one-time litigation settlement.
Hold on, let me get this straight. They spent nearly $86 million just handing out shares to their own executives and employees?
Yes. And, startups rely heavily on stock-based comp because it preserves cash. Instead of paying an engineer or an executive $300,000 in cash, you pay them $150,000 in cash and $150,000 in company stock.
It keeps the lights on longer.
Right. But it operates as a hidden tax on you, the retail investor. Every time they print new shares to pay their staff, the shares you hold in your portfolio represent a slightly smaller percentage of the company. It directly dilutes your ownership.
So if I'm connecting the dots here, we have a company facing a brutal margin squeeze on their airport operations, a ballooning administrative overhead, and an agonizingly delayed timeline for commercializing their actual air taxis.
Yep.
Which brings us to the exact reason they needed a total strategic pivot. Their solution isn't just to cut costs, it's to buy an entirely different, already profitable business to bridge the gap.
Right, and this is where the Boeing transaction changes the entire fundamental profile of Archer Aviation. They announced this landmark, all-stock transaction to acquire 3 distinct Boeing-owned companies.
Huh.
Wiskero, SkyGrid, and In-Situ.
Let's break those down because this is a massive shift. Starting with Wiskero and SkyGrid, what exactly do those two bring to the table?
Well, Wiskero brings autonomous flight tech.
Yeah.
They have been pioneering self-flying electric aircraft. And this is actually crucial for the economics of air taxis.
Why is that?
Think about it. If you have to put a human pilot in a 4-seat air taxi, that pilot plus their seat plus their physical controls weighs roughly 200 to 250 pounds.
Oh, right. And in a battery-powered aircraft, weight is everything.
Exactly. If you remove the pilot and fly autonomously, you instantly gain 250 pounds of payload capacity, which you can use for another paying passenger, or a heavier battery for longer range.
That makes total sense. And SkyGrid, what do they do?
SkyGrid brings airspace management software. You can't have 10,000 autonomous air taxis buzzing over Los Angeles, relying on a few guys with binoculars and radar in a traditional air traffic control tower.
No, definitely not.
Right, so you need aviation-specific AI-driven software to manage that low-altitude airspace.
Okay, but In-Situ is clearly the crown jewel of this deal, right? Because Wisk and SkyGrid are tech plays, but In-Situ brings immediate, hard financials. We're talking about over $200 million in annual profitable revenue.
Yeah.
They have operations in 35 countries and a proven track record of building over 4,000 Group 2 and Group 3 unmanned aircraft systems for the military.
And we should clarify that terminology because Group 2 and Group 3 drones aren't the little plastic quadcopters you buy at Best Buy to, take pictures of your roof.
Right.
We're talking about heavy, catapult-launch military surveillance drones with 10 to 20-foot wingspans. In-Situ has nearly 2 million autonomous flight hours of real-world data with these platforms.
And management was very clear on the earnings call about what this means. CEO Adam Goldstein is officially repositioning Archer from a pure pre-revenue consumer air taxi developer into what he called an end-to-end physical AI platform for aerospace and defense.
Yeah, the rebranding is aggressive.
They even introduced new product lines to back it up. The Halo Thunder platform, which is a hybrid VDL aircraft developed with Anduril for defense programs, and ZEE, an AI foundation model for airport trajectory prediction.
Right.
But here's where it gets really interesting, and I have to push back on you here, or at least play devil's advocate. Is this a brilliant strategic masterstroke to capture massive defense spending, or are they just buying a profitable drone maker out of sheer desperation to buy time? Because, let's be real, certifying the Midnight Air Taxi with the FAA is taking forever.
Oh, it is entirely about buying time. But honestly, that doesn't make it a bad strategy.
Really?
Yeah, if we connect this to the bigger picture, you have to look at what's known in the aerospace industry as the Valley of Death.
The Valley of Death. Explain that mechanism.
It's the agonizing multi-year gap between completing your research and development and actually achieving scaled commercialization. Getting FAA certification for a novel electric aircraft with tilting rotors is totally unprecedented.
Right, the FAA is not known for moving fast.
No, and they demand a failure rate of 1 in a billion flight hours. Proving that requires years of testing, redesigns, and lawyers. During this phase, you are bleeding capital every single day and generating zero revenue.
So a lot of companies just run out of cash.
Many aerospace startups die right here. By acquiring in situ, Archer secures an immediate positive free cash flow. That $200 million existing revenue stream acts as a financial bridge over the valley of death to offset their massive EVTOL cash burn.
So it's a survival tactic dressed up as an AI expansion. They are using profitable military drone sales to fund the civilian flying car dream.
That's one way to look at it, yeah.
But that brings us to the severe cost of this deal. We established that buying Boeing's assets solves Archer's immediate revenue problem. But how are they paying for it? And how long can their balance sheet actually survive? Let's look at the liquidity.
Good idea. Archer ended Q2 with $1.56 billion in cash, cash equivalents, and short-term investments. And on paper, to a layman, $1.5 billion sounds incredibly robust.
But the burn rate is fierce. Let's look at the actual outflow. They burned $156.4 million in operating cash just this quarter.
Wow.
Add to that $37.1 million in capital expenditures, plus the $25 million they spent to buy that Hawthorne FBO gas station we talked about earlier. Their first half cash outflow was roughly $376 million.
Yeah, so if you annualize that burn rate, Archer has about 2.1 years of cash runway left before they hit a brick wall.
And context is everything here. Let's compare that to their closest peer, Joby Aviation, ticker JOBY. Joby is navigating the exact same FAA certification valley of death. But Joby ended the quarter with $2.26 billion in liquidity. And their cash burn gives them a longer runway of roughly 2.7 years. So my question to you is a 6-month difference really that big of a deal in corporate finance?
In aerospace certification, a 6-month difference is life or death. If the FAA comes back from a flight test and says, hey, we need you to redesign the thermal management system on the battery pack, that is easily a 4 to 6 month delay.
Just gone.
Yep. Joby has the cash cushion to survive that redesign without going bankrupt. Archer's margin for error is razor thin, which makes the structuring of this Boeing deal absolutely critical to understand.
So let's talk about the cost of the Boeing deal, what we're calling the dilution trap, because Archer isn't paying cash for in situ, Wisk, and SkyGrid.
Right, they don't have the cash to spare.
No, they are paying via equity. They're issuing new Class A shares equal to 19.75% of their pre-close shares. That leaves Boeing with a roughly 16.5% post-close stake in Archer, plus a seat on the board of directors.
And it doesn't stop there.
Right. Archer is also handing Boeing 2 massive warrants worth $100 million each, with strike prices of $13 and $17.88. Walk me through the mechanics of a warrant, because this sounds pretty dangerous for retail investors.
It definitely can be. A warrant is essentially a long-term options contract issued directly by the company. It gives Boeing the right to buy new shares of Archer at a specific price, in this case, $13.1788 sometime in the future.
Okay.
So imagine a scenario a year from now where Archer's air taxi gets certified, the market goes crazy, and the stock rallies up to, say, $15 a share. Boeing is going to exercise that first warrant. They get to buy $100 million worth of stock for only $13 a share, instantly capturing a profit.
But where do those shares come from?
The company has to create them out of thin air, which means the total pool of shares expands massively, diluting the value of every single share held by a retail investor. Warrants act as a heavy ceiling on the stock price. Every time the stock tries to run up past those strike prices, millions of new shares flood the market, basically suppressing the rally.
So what does this all mean for you, the retail investor? Paying for this with equity preserves cash, sure, but it's like building a massive extension on your house by giving the contractor a 16.5% deed to your property, plus the right to claim even more of your backyard if your property value ever goes up. Aren't existing shareholders footing a massive dilution bill here?
They absolutely are, and there is a fascinating mechanical effect this dilution has on the earnings report itself. If you're holding Archer stock right now, you might be looking at the headline numbers and feeling pretty good. But there's a dilution paradox buried in their GAAP numbers.
What do you mean?
Well, Archer's GAAP earnings per share loss appeared to narrow. It went from a loss of 36 cents per share a year ago to a loss of 34 cents today.
Right. An uninformed investor looks at that and thinks, great, their per-share profitability is improving. The loss is shrinking.
Exactly. But that is a complete mathematical illusion caused by the rapidly expanding share count. Think of the company's net loss like a massive pie of debt.
Okay.
A year ago, that pie was cut into a certain number of slices. Today, because they have printed so many new shares to pay employees and fund acquisitions, that pie is cut into millions of additional slices.
Ah, so because the pie is being cut into so many more slices, the loss assigned to each individual slice looks smaller?
Precisely. The absolute net loss actually widened by nearly 28% year over year, hitting that $263.2 million mark.
Wow.
The company is losing significantly more money, but the per-share metric masks the internal cash hemorrhage. And remember, that calculation is from before the new 19.75% equity issuance to Boeing even hits the books.
Okay, but I want to push back on your pessimism for a second here. You are painting a pretty bleak picture with the dilution, but they did secure a $200 million profitable revenue stream with In Situ. That's real cash flow. That isn't just window dressing, that's a lifeline. Assuming they get the keys to In Situ, why wouldn't that instantly improve their balance sheet?
Because the execution risks of the M&A itself. You are taking a pre-revenue Silicon Valley eVTOL startup that uses Slack and Agile software development, and you are trying to staple it to 3 distinct legacy Boeing divisions that operate under highly classified, rigid defense protocols.
So the culture clash.
It's going to be massive. It's like trying to graft a 50-year-old oak tree onto a sapling. The friction alone could set the whole thing on fire.
Yeah, that sounds messy.
Merging corporate cultures, consolidating disparate IT systems, and managing legacy defense supply chains across the 35 countries where In Situ operates it is going to require immense management bandwidth.
Not to mention money.
Exactly. Historically, this kind of M&A overhead triggers massive, unexpected costs. Now, management claimed on the earnings call that this integration will not structurally increase their overall cash burn, but investors need to watch those integration costs closely in the coming quarters.
Right, because the friction of merging these giants could very easily wipe out the free cash flow that Situ generates, defeating the entire financial purpose of the acquisition.
It's a high-wire act. They are betting that the $200 million in drone revenue will hit the bottom line cleanly, without the integration dragging them down faster than the FAA certification process already is.
And that is exactly why their Q3 guidance was so sobering. Because despite this massive pivot, despite bringing in Boeing's revenue, they are projecting their Q3 adjusted EBITDA loss to remain completely flat, between $170 million and $200 million. The heavy capital burn is going to persist.
Yeah, the financial gravity hasn't changed yet.
So we step back and look at the trajectory of this company. They IPO'd on the promise of revolutionizing urban transit, whisking commuters over highway traffic in sleek electric air taxis. But as the regulatory reality of the Valley of Death set in and the cash began to burn, the narrative had to evolve just to survive.
It really did.
Which leaves you, the investor, with a critical question to consider about Archer's ultimate identity 5 years from now. With In Situ's highly profitable defense drones integrating into the balance sheet and the Halo Thunder military platform taking center stage, will history remember Archer Aviation for the futuristic consumer air taxi dream that originally sparked its IPO? Or will it be remembered as a hardened, autonomous military defense contractor that successfully used the flying car hype to fund its aerospace ambitions?
It's the ultimate pivot, and only the balance sheet over the next 24 months will tell us if they survive the transition.
That's all for today's deep dive. Make sure you follow the show for your daily no-nonsense earnings coverage. See you next time.